Hello and welcome back to our series on personal finance fundamentals. We have been looking at issues regarding insurance, cash savings, savings plans, right? Today, we are moving up our asset management, our risk management list, right? We've talked about insurance, cash on hand, savings plans with regular monthly payments into a savings plan. That's diversified across maybe different mutual funds, index funds, and we use dollar cost averaging over time to mitigate our risk there. Um, furthermore, Furthermore, we have lump sum investments where we take a single position, a large amount of money on a single instrument at a specific price at a specific time, and we do this because we believe that over time, the midterm to long term, that this asset will go up in value. Real estate is the next level of risk because there's a lot going on with the operation of real estate, repairs, taxes, vacancy, lots of risk associated with it, and it's much more expensive to diversify. I can diversify across a savings plan very inexpensively. It's not so expensive to diversify across lump sum investments. $1,000 here, $5,000 there, $10,000 here. Real estate, in order to diversify, you're going to have hundreds of thousands of dollars, and you're probably going to leverage the assets with debt. You can be borrowing from the bank as well. Um, and that's where we get to startup investments. Startup investments are not so difficult to diversify, but they are very risky. And so we use similar strategies with the savings plan or the lump sum investments as we do with the startup. Right, so we know that risk goes up along this scale here, and what we're going to do with a lump sum and with a startup investment is we are going to make a portfolio just like we're going to do with any other asset class, right? So this portfolio is easy to do with savings plans. It's reasonably easy to do with lump sums. It gets more difficult with real estate, but it becomes easier now. Now it's not so difficult at all with startup investing. It used to be very difficult. This type of asset class used to be reserved only for multimillionaires or what we call accredited investors, people with licenses in Series 6, 63 kind of licenses for trading stocks, mutual funds, things like this, right? But now, thanks to the 2016 Jobs Act, we normal people with less than $1 million, we have access to Regulation A offerings in private equity. Now, private equity is basically what we're looking at. It's the same kind of term that we'll use to be startup investments, right? So right now, I basically have a startup investment portfolio that looks like this. I've got two assets. I've got Start Engine and I've got Ground Floor. Those are my two assets. And over this year, I hope to at least get as much as two more, right? And over the next 10 years, I plan to build my portfolio of startup investments around $1,000 each investment to where I get to about ideally 20 to 24 assets in this class. That's statistically about where we want to be. Okay. There's a number of reasons. Why do we consider this? Why are we looking at, or First, let's consider the major drawback of startup investing. Number one, the number one major drawback to startup investing is liquidity. Okay. Once you're invested, you're in until the end. This is the number one problem. Okay. In a savings plan, well, cash is liquid already, no problem. That's the most liquid. Savings plans, we can usually liquefy a portion or all of a savings plan pretty easily. Lump sum investments are the same. Real estate is a little more difficult, but we can take out equity on a loan or we can sell the property. The other thing is that real estate tends to produce passive income. So in that way, we get a different kind of liquidity. It's not liquidity from the investment itself, but it's income that's produced passively through rents. Okay. Now, startup investments, they end in one of four ways. Okay. They have four ways of ending, and the first one is failure. Most startup investments end in failure, somewhere around 80%, right? Number two, they might get successful enough as a company, but not successful enough to go public or get bought out. And what they do is they might start to produce a dividend income. So now this startup investment, like real estate, can produce a passive income. This isn't ideal, however. We don't want this startup company to be paying money out to us as investors. We want the startup company to be reinvesting their earnings into growing their company, because really we're looking for a number three, which is a buyout, right? Some sort of buyout. Or number four, an IPO, right? An initial public offering. These number three and number four is how startup investors make most of their money. And the idea is that this will happen with about 20%, or about 20% of startup investments will go this way. So that's why we want 12 to 24 investments in our startup portfolio, because we'll know that somewhere around 4 to 5 of these investments should go public or get bought out. And when that happens, usually we can expect to see somewhere around a 2,000% rate of return. So if I've got $1,000 invested in 20 different firms and I get 20% of them, right? So that's 4 of them are successful. That's $4,000. That's basically turned into $80,000 over pretty much a 10-year period. We're looking at a timeline of 10 years for the entire portfolio to be settled. Any single investment should be considered as a 3 to 10-year investment, right? And okay, so I know that my $80,000 will net me, after losing the $16,000 on the other failed companies. All right, I'm gonna get a net of $64,000. Not bad over 10 years. That's a pretty decent rate of return on a $20,000 investment. It's better than 300% over 10 years. So yeah, it's like 30% per year, which is pretty good. But we can see that in other investments too. Real estate can do that without being quite as risky, but at the same time, real estate requires a lot more capital. Right now, because of the Jobs Act, the 2016 Jobs Act, we can get involved in a startup investment for as little as $100 or $200, and you can have private equity owned. Right? My budget, I like to use $1,000 increments. And I pretty much, I mean, if I'm less confident in an idea, maybe I'll put in $500 or $200, something like this. But really, for average's sake, I want to have all my positions around $1,000. That's me personally. That's my plan. Okay, but why? The real reason to be doing this is that, you know, we're hunting for the unicorn, and the unicorn. This is a real term in startup investing. The unicorn is looking at a 200,000% rate return, right? I think Reddit is a company that if you had invested in 10 years ago and in private equity, it would have turned 200,000%. Zoom in 10 years from going from startup to its current public traded position is a 600,000% proposition, right? So these companies exist, and the reason we want to get involved, and the reason we want a bigger portfolio rather than a smaller portfolio, is that increases our chances of one of our profitable investments being one of these unicorns, right? So if I only have 2 successes versus 4 or 5 successes, it's more likely that I'll have a unicorn out of 5 instead of a unicorn out of 2 or 3, right? So this is the real thing. So if my $1,000 investment turns into a $200,000 payday 10 years down the line, that is really what I'm hunting for, with the knowledge that on the statistical average, I should at least make my $64,000 net out of the project in 10 years. That's why I look at startup investing. Okay. Now, I want to share something else with you here, just a little bit on tax. I have this document here from the group that I joined. I joined a startup investment group so that I can benefit from that group's expertise in startup investment, the community's expertise across industries that the members are involved in, and the deal flow. Because as an individual, I'm going to have to vet a whole bunch of different ideas. I'm going to have to look online. I'm going to have to look for, like, for example, Start Engine and Ground Floor. These are 2 of the companies that I invested in, and I would never have heard of them without getting involved with the group. Startengine.com and groundfloor.us. These were my two investments. Show you real quick. Here we go. Right, we can see right here my investments, and here's my $1,000. I have 77 shares. That's 13 shares at 70. That's 77 shares at $13 a share. So for me to hit 2,000% on this investment, this company has to become traded at $260 a share. Well, tech companies get traded around $1,000 a share all the time. If we look at Amazon is like $3,000 a share. It's incredible, right? So Shopify is around $1,000 a share. Apple is around $130 a share. So I mean, seeing a company like this eventually traded around 260 is pretty easy. Seeing them go up to around 2,000, I don't know about that. But it's a possibility these guys might become a unicorn because they have an innovation that I believe in, right? If we took a look at Ground Floor, this is my other investment, startup investment. They are a company that works in loans on residential property projects. Okay, so their members, their retail members, lend money through the platform to property developers who fix homes, flip them, and pay back a contracted rate of return. So these lenders are not investors. I am an investor. I bought equity in Ground Floor, I think at $18 a share, $1,000 lot, right? And these people who use a platform, whom I'm also working this out, I will join the platform as a lender as well. These people make contracted rates of return on the amounts of money that they lend to the projects that are offered on the platform. Okay, so these are my two investments. I would not have known about these at all if it weren't for the group that I joined. And so this document from the group that I joined talks a little bit about tax. A couple things to look at here with tax, right? As an American, we get great tax benefits through the Jobs Act, right? That this right here, the IRC 1202 means that if we make money off of a startup investment after 5 years, it is capital gains tax free. So if mystartengine.com turns a profit for me in 5 years, if I make $20,000 or $200,000, it does not matter. In America, for me as an American, I am tax-free. It's also possible to roll over those funds. Let's say Start Engine pays out in 3 years' time. Okay, now I've got $20,000 or even $10,000, whatever I get paid, it gets bought out and I get paid an amount. I've got this return on my investment. I can roll over the gains into other startup investments, and then I can add that to that next investment. Only needs to go for 2 years before I am exempt from taxes, right? I also have advantages for write-offs, right? So I get to write off more of my losses. So if I have other assets, okay, if I have other assets like real estate and lump sum investments and other things that I might see capital gains from, okay, if I see a $1,000, $2,000, $3,000 loss over my startup investments in a year, I can write off more of that loss against my capital gains on other assets. So it becomes a very good tool for leveraging a small amount of extra money. For me, $3,000 a year is my budget. I can leverage that against the gains that I might see from other assets, like say my trading income, right? So if I'm making $20,000 a year, hopefully in the next couple of years I'll get up to that point. If I'm making $20,000 a year and I'm seeing a couple $1,000s a year worth of startup investment losses, I can write 35%, I believe 35% of my losses can write off against my capital gains on my trading, right? So, or somebody can write it off against their gains on real estate sale or a lump sum liquidation, something like this, okay? So these are some of the advantages for startup investing. Yeah, let me know if you have any questions. We'll carry on. We'll talk about business ownership and trading as a risk level and an asset class in the next video. Contact me, give me any questions in the comments, like, subscribe, and we'll see you for the next video. Thanks. Bye.